Quick disclaimer, guys. None of this is financial advice. This is just my opinion on my outlook on what I think is going to happen in the next 6 to 12 months. Enjoy the video. Hi, what's good? What's going? How are you guys? Back with another video. And this one is going to be a little bit of a different video. I'm kind of going to talk about my outlook for the next 12 months on the economy in the world and where I think potentially the most profit is to be made in one single asset, not in a basket of assets, or what is going to do better in terms of multiple things. I'm just working with one idea. So here in front of us, and my whole concept to this is going to be basically how we've been in a recession since the beginning of the year. We just haven't felt it, and on top of that, these things take months to play out. That's usually how they work. Months, I'm sorry. They usually take 12 to 24 months, so basically a year or two to play out. So I wanted to start with the concept that I just talked about of how we've been in recession since the beginning of the year. I'm sorry. So when we go here to this government website, I forget what it's called, but it's basically where they release the GDP numbers. Our GDP in Q1 was more than negative. What was it? Negative 1.5, just about, almost 2, almost a negative 2% decrease in the economy. Q2 was a little less at 0.6, and then Q3 was at an increase of 2.6%. With those numbers, as you can see, we've been in a recession since the beginning of the year for the last 4 months, because Q4 is about to end. At the end of December, we get another GDP number, and I guarantee you it may be high, but come first quarter of next year, it's not going to look pretty. Why do I think that? Well, by book, the definition of a recession is a contraction in the economy, but besides a contraction, it's specifically 2 declining quarters of negative GDP. So exactly what this is, 2 quarters of negative GDP or declining GDP. And then obviously the third quarter is an outlier, and potentially the fourth quarter could also be an outlier. But you also have to remember that there was over $7 trillion pumped into the economy, both fiscally and monetarily, meaning by the government and by the banks. There was a pump of $7 trillion, and it's why 2021 was 2021, and why 2020 was 2020. So now let's take a look at the federal funds rate. So here what we have is the federal effective funds rate, and it's the interest rate that the Federal Reserve sets for banks. And this always correlates with interest rates in your day-to-day life, meaning credit cards, mortgages, debt, any other type of stuff that has to deal with rates. So as you can see here, all year, since the beginning of 22, we have gone on a mad run of increasing rates. So much so that we're starting to see little glimpses of things not going well and things not being as funded as they need to be. Because like we said, all the stuff that we were doing here from 2020 to 2022, as far as government money, stimulus checks, PPP loans, helping in any type of assistance. Basically, everybody got money, whether it was the big players that had millions and billions, or whether it was the small folks that had nothing. Everybody got something. And in that madness of the 7 trillion, you got no rates at all, no rate increases, not a single one. And now everything that we were doing from 2020 to 2022, as far as all those soft conditions, are gone. They're all gone. The Federal Reserve has been doing quantitative easing, if I'm not mistaken, for the last 2 months. Or the last month. Yeah, the last month. And if that's bound to continue into 2023 and continue for another 4 quarters, after we've technically, by book standards, technically already been in a recession, we're going to have 2 years of negative declining numbers with outliers in between the third and fourth quarter. It doesn't really matter. The ultimate point is that something's bound to give, whether it's the stock market, the housing market, or whatever it is. But usually it's stocks first and then housing. Housing is most important. And this is why housing is most important. You see this increase in rates? It has made the same house absolutely unaffordable in a matter of less than 9 months. So let's take a normal $250,000 house or $300,000 house, which I think is probably about the average. If anything, you can do the math for yourself. It's pretty fucking simple. 300,000 on a 30-year. At current interest rates, currently, we're at 7.5%. And your monthly payment is going to be $2,100. If you go back 9 months ago to basically the beginning, a little bit more than 9 months, to basically the beginning of 2022, the same house would cost you this much a month. Because rates were about 3%. A whole $1,000 less, almost $1,000 left, basically. $1,265. Let's write this down. I don't have a pen and paper. So a whole $800 less. $800 to $900 less. Let's round it up and go 1,000 even. A house 9 months ago cost you a whole $800 to $1,000 a month less than it currently costs you in a matter of 9 months. So you mean to tell me we're going to continue on the same path that we have for the last 9 months for another 9 months, meaning 3 quarters, and nothing's going to give in the housing market when we're already starting to see numbers come down? We go to XHB, which is an example. This is homeowners builders. It's basically people building houses and making money off of it. Pretty simple. It's an ETF. Beginning of 2022, when the recession started, literally when it started, because we've been already 2 quarters negative, and we'll see how the Q4 numbers look, and I guarantee you they're not going to look pretty good. Even if they look good, Q1 is not going to look good at all. 2022, beginning of the year to June, home builders collapsed. And this was in between this collapse right here. This collapse was exactly when we had the 2 negative declining quarters of GDP. Coincidentally, I just noticed. But back to the point, this housing is the US economy as well as the stock market. Those are the only 2 things that keep us going. Without those 2 things, jobs start to decline, and then it starts affecting the real world economy. Once those 2 go, the real economy is next. But if you're the normal person, you felt it all year that the economy has been off. Everybody can feel it. If you're rich, you could care less, and maybe you lost a couple million here and there, but guess what? You still have a couple million wherever the hell you please. But the common people have felt it in both inflation, interest rates, unaffordability, you name it, we've all felt it. And maybe we're just going through the current motions of stabilization before the real collapse comes. But in my opinion, something's bound to give. And going back to the original point of this video, which was my bet, my number 1 bet that I'd bet on. We're going to look up real quick how big the stock market is. It's about $22 trillion. Now let's look at the bond market. $46 trillion, estimated to be $119 trillion worldwide, and $46 trillion for the US market. Basically 2 times bigger than the stock market is what we're betting on. Bonds is TLT, and the SPY is stocks. Is the easiest way I could look at it. This is 2 times bigger than this in terms of money flowing in and money being invested. Why? Because obviously this is safer than this. So going back to my bet. My bet for the year is that we're going to get something like, let's look for it. We're going to get something like this. You see this? Let's zoom in. You see this? You see this nice little rise? I wouldn't even be surprised if we get something like this. And it's a multi-year thing. But I don't think it's that. I think we're going to get something like this. And we're going to get something, and we're going to rocket off like a fucking rocket ship because something blows up. Something gives. Something says, I can't. I'm underwater and I no longer can. And more just keeps proving it. 20%, think about this fact. 20% of the US stock market is zombie companies. Look up what a zombie company is if you don't believe me. But the definition of a zombie company is somebody that only can afford to make payments on their debt. That's not a company. All you're doing is paying employees and giving people work to pay your debt. There's no profit generation. There's no money coming in. Look, hear this. A zombie company is a company that needs bailouts in order to operate, or an indebted company that is able to repay the interest on its debt but not pay the principal. Meaning you can't pay off your debt. You can only pay off a part of it every month. You have more debt than you're bringing in income. If you had more debt currently right now, meaning you owed more money than you were currently making, and you would make for the next 2 to 3 years, you'd be in a pretty fucked situation. And that's how 20% of companies are in the United States stock market. Not to mention that $7 trillion got pumped into it. And we've now been in a recession all year, in my opinion. So we saw 08. We're looking for something similar of a rise, a drop, and some type of fucking explosion. We can't go back to 01 because they don't give you data till then. They don't like you enough. So then we'll go to 2019 when we had the repo spike, which was repo rates completely went up overnight. They went to amounts that nobody could afford and nobody was able to service that overnight. And the Federal Reserve had to stop lowering rates. And this is what happened to bonds when they stopped lowering rates. Bottom of 19, the bond market started sniffing it out. Then come 2019, you get a major surprise. Mind you, in the year 2019, the bond market was already predicting a stock market downturn. Was already predicting one. And we had 2019, which was the first quote-unquote signal. But then it took from 2019 August to March. How much is that? It's like, what, 3 months? It's like 5 months before it came down, did what it was going to do, and then it had that exact moment. Since the beginning of 22, bonds have been just... Let's just say this was the beginning of 22 because it was basically the end of 21. All the way to the end of 22, bonds have done nothing. They have done absolutely nothing because of the $7 trillion that got pumped. Interest rates went up and other things were better investments than bond prices. Yields were paying a lot more than it was to own a bond. But that's not what we're looking for. What we're looking for is instances like this. Instances like this where something blows up, something is wrong. Now, why do I say something is wrong? Another reason is, look at this, guys. Look at this. Tell me how this makes sense. Don't pay attention to the chart right here. Currently, the US 3-month is paying you 4.3%, 6-month 4.5, X, Y, and Z, and the rest on. How is the 3-month paying you than a 30-year note? How is the government paying you more interest to hold it for 3 months rather than a whole 30 years? Even the 6-month, the 1 year, the 2 year, they're all above the 30 year. How is a government gonna pay you more to hold it for a shorter duration than for a 30-year duration? That's never what you want to see in the bond market and in yields for a government. It doesn't make sense. It basically means there's something wrong that you're paying people more for sooner debt, for people to come in sooner rather than hold it for a long time. That means you're uncertain of the future, but you need current money now because of some existential circumstances or because there's a signal going on that something is wrong. That's how I view it. I view it as something is wrong in the market. It's just a matter of when, just when it gives. And now the ultimate signal for when it gives is when you see the 3-month higher than the 6-month, and the 6th month higher than the year. When that starts turning around, because right now it's flipped upside down. It's 3-month is still, you see, this is still good. This is still what you want to see. You want to see these numbers go from smaller to greater in terms of here to there. With the longer duration, the longer it pays you. It makes more sense. It's kind of common sense. But right now it's not. And that's my signal. When this starts becoming less than the 6-month and less than the 1 year, it's the ultimate signal. It's like this is bound to give. So going back to the number one bet, TLT is my number one bet. I am looking for this crazy instance where we're going to get one of these, goes to 140, pops back down 6 months from now. So meaning the next 3 months, we're going to go from here to 130. And from 130, we're going to chill for a bit. And then after 130, I'm going to double down on how right I fucking am, because that's how much I believe in myself. By the way, not financial advice, and I have to put a disclaimer in this video. This is all my opinion on where I see the next 12 months being the best in terms of gambling. Remember that, gambling, because this is exactly what it is. So, going back in retrospect, something along the lines of going to 130, coming back down, resting in that same 130, 125, and doing exactly what it did here, back up all the way to 170, 180, 190 if it gets there, but I'm looking at other all-time highs. I'm looking for that same setup in the next 12 months, and this is my number one bet, and I'm betting on nothing else. Because it's make it or break it for me. It's not the same for you, not financial advice. I hope you guys enjoyed the video. Like, comment, and subscribe. If you have anything you'd like to share, anything you'd like to ask, put it down in the comment section below, and I'll try to get to it and make sure to go through the comment section and answer anything. Otherwise, hope you enjoyed this little bit of a different video, and I'll see you guys on the next one.